Hi guys, Brown Asset Management here, and today I'm doing a stock review of Johnson & Johnson, ticker symbol JNJ, using my 6 simple steps. Stick around at the end of the video to see if I think Johnson & Johnson is still a buy in 2021. But be first, like and comment if you enjoy the video, and subscribe if you enjoy investing and personal finance videos. Johnson & Johnson is a holding company which is engaged in the research and development, manufacture and sales of a range of products in the healthcare field. It operates through its 3 main segments: consumer, pharmaceutical and medical devices. The consumer segment includes a range of products used in the baby care, oral care, skin care, over-the-counter pharmaceutical, women's health and wound care markets. The pharmaceutical segment is focused on 5 therapeutic areas, including immunology, infectious diseases, neuroscience, oncology and cardiovascular and metabolic diseases. The medical segment includes a range of products used in the orthopedic, surgery, cardiovascular, diabetes care and vision care fields. Johnson & Johnson currently has a market cap of $422.9 billion, making it one of the largest companies in the world today. Let's have a look at the share price of Johnson & Johnson over the last year. It is currently at $160.75, which is almost at its all-time high. The pre-pandemic level was $153.53, and the lowest over the last 52 weeks was $106. This is the lowest it has been since the end of 2016. Now I'm going to go through the 6-step process I use to help me determine whether or not I should buy a stock. The first is PE ratio less than 20. Is the revenue increasing? Is the profit increasing? Are the number of shares outstanding decreasing? Are the current assets greater than the current liabilities, and is the free cash flow increasing? Let's take a look at the first step, which is PE ratio less than 20. As you can see, the PE ratio for Johnson & Johnson is 25.7, which is higher than the historical average of the S&P 500, which is around 15. So this is a fail, but not by much. Now let's have a look at the financials. The earnings are on the 26th of January this year, so in a couple of weeks. So these values are from the 29th of December 2019. So once again, the earnings from 2020 will be released on the 26th of January. As you can see, Johnson & Johnson's revenue has gone from $70.07 billion to $82.06 billion. That is a check mark, and as you can see, it's increased around 17% in that time, and a 0.5% increase from the prior year. Now let's have a look at step number 3, which is the profit increasing over the last 5 years. The value we're looking at here is net income after taxes, and that has gone from $15.41 billion to $15.12 billion. Which is a 2% decrease in that time, and that is a fail. Step number 4 is, are the shares outstanding decreasing or flat? The reason for this is if you have one share of a company and the company has 10 shares outstanding, you own 10% of the company, but if the company creates 10 more shares, there are now 20 shares outstanding, you still own that one share and now you own 5%. So as I said, we want this decreasing or flat. The shares have gone from 2.76 billion to 2.63 billion. So that is a check mark there. Very good from Johnson & Johnson buying back their shares. Now we'll move on to step 6, which is current assets greater than current liabilities. So the current assets represent all the assets of a company that are to be sold or used within 1 year. And the current liabilities are the short-term financial obligations that the company has due within that 1 year. As you can see, the current assets are $45.27 billion, whereas the current liabilities are $35.96 billion. So that's a massive checkmark there. They can easily pay off all their debts. Also looking at the total liabilities, they're $98.26 billion, so they can pay off 40% of their total debt, which is also very good as well, but not a checkmark, not an extra checkmark. But it is good to know that they do have those assets to be used. Now on to the final step, which is the free cash flow increasing over the last 5 years? To get the free cash flow, we need to take the cash from operating activities minus the capital expenditures. The cash flow from operating activities indicates the amount of money the company brings in from its ongoing and regular business activities, whereas the capital expenditures are funds used by the company to acquire, upgrade or maintain physical assets such as their property or their equipment or technology. Once we take these two values from each other, we'll get the free cash flow, and this is the free cash flow that the company can use to pay its creditors or pay its dividends to its investors, and it can also be used for share buybacks, which we have seen in the past. The free cash flow has increased from $16.11 billion to $19.92 billion, so that's a check mark again. Good news for Johnson & Johnson. So looking at the latest free cash flow figure of $19.92 billion and its market cap, we can see how much the company is selling times its free cash flow. So 422 billion divided by 19.92 billion is around 21 times free cash flow, which is a little high for a company this slow going, but definitely within the margins that we like to look at here. An extra thing I like to look at is the dividend, and definitely for Johnson & Johnson this is an area people really do care about. So as you can see, the yield of the dividend is 2.44%. The annual dividend is $3.75 a share. The next dividend amount will be $1.01 a share, and this ex-dividend date is the 22nd of February 2021. So if you buy your shares before then, you'll be eligible for the next dividend. Also, from looking at the graph, you can see that the dividend amount has increased over time. As said before, the total free cash flow is 19.92 billion and the dividend is 9.92 billion, so the dividend is very safe. There's no issues with Johnson & Johnson paying that out. So let's quickly go through the 6-step process. PE ratio less than 20, that was a fail as the PE ratio was 25.7. Is the revenue increasing over the last 5 years? The answer was yes. It went from 70.07 billion to 82.06 billion, so it passed there. Is the profit increasing over the last 5 years? That was a fail. It went from 15.41 billion to 15.12 billion. Are the shares outstanding decreasing? That was a pass again. It went from 2.76 billion to 2.63 billion. Step 5, are the current assets greater than the current liabilities? Yes, they are. 45.27 billion to 35.96 billion. And is the free cash flow increasing? Once again, yes. Went from 16 billion to 19.92 billion. So that is 4 out of the 6 steps passed. Let's quickly have a look at some of the analyst ratings. The Refinitiv ratings have it as a buy with an average target of $167.59, 13 analysts buying, 5 holding. The tip ranks have it as a strong buy with 5 buying and an average price of $177. And the tip ranks sentiment has it at $177 with everyone bullish on J&J. So do I think Johnson & Johnson is a buy in 2021? I would say yes. I think this company still can continue growing. I think the profit has decreased a little bit, which is worrying, but the revenue is increasing. They are buying back the shares. The dividend is safe. I'm looking forward to their earnings on January 26th. If the share price drops at all, I will definitely be jumping in there and buying more. I think a company this size, which has been steadily growing for as long as it has, with a very big dividend, which is safe, I think it's a great investment for 2021 and beyond. Right guys, that was my analysis of Johnson & Johnson, ticker symbol JNJ. I'd like to thank you all for watching. Leave a like if you've enjoyed the video and give a comment on your thoughts on Johnson & Johnson in 2021. Please subscribe if you enjoy investing in personal finance, and I'll catch you guys in the next video.